Okay, Matt, we're seeing quite a pullback after a very exciting week, or even last couple of weeks here. Has all these the optimistic news, so to speak, the better than expected third quarter GDP, the alert level two announcements already been priced in? Are we seeing a very strong resistance level?
Well, Danny, right now the market is at a very strong resistance level between 7,300 and 7,400. However, this feels an awful lot like last year, right? There's a lot of deja vu going on in the market where we're rallying into year end. Economic data looks good, earnings look good, uh, and COVID cases are on the way down, right? So it feels a lot like Q4 2020. Uh, with that in mind, I'm a little cautious heading into Q1 of next year, right? Um, because while we already do have vaccines rolling out, we have a new sort of demon to watch out for, and that's inflation.
Mm-hmm.
So this is it feels an awful lot like last year, but with slightly different risks now. So while I am optimistic heading into year end, I just don't think this is a uh, straight line upwards going into next year.
Okay, Matt, what about the third quarter earnings? I mean, third quarter saw, ECQ in NCR, and nevertheless, we still had this rally after all of these earnings are well, earnings are still coming out. Has it been better than expected? Does it in any way illustrate the recovery is faster than what you were expecting?
Well, earnings so far have been quite nuanced. So let's take banks for example. Uh, the bright side in bank earnings across the board has been that they haven't been losing as much money as we thought on non-performing loans. So that's a good sign. But their revenues aren't particularly stellar, and their margins haven't been expanding. So it's a mixed picture, right? The headline number looks good, but if we look a bit deeper, business is not yet back to normal. So until we start seeing sort of the things under the hood improving, I'm hesitant to say that we're back to business as usual, which we're clearly not.
But can you say, at least for the banks, that the worst is over? Because they've stopped basically putting aside provisions, saying that that the recovery is imminent, the loan growth is imminent, and the third quarter is behind them.
Well, I do firmly believe that the worst is over for banks. I am overall bullish on banks for next year, particularly because as the economy opens up, you know, th- that demand for credit, there's going to be revenge borrowing coming next year, right? The people are going to need capital to sort of roll out their businesses again and to expand. Uh, because let's keep in mind, right, the last year or so has been a year of survival, not necessarily of expansion. So if we believe that next year is when the economy starts kicking into gear again as far as normalcy is concerned, then banks should do very well.